Joining us right now is the host of the Pebble Beach Pro-Am, AT&T Chairman and CEO Randall Stephenson. Randall, thanks for being here today.
Thanks for having me.
You know, I was walking the course yesterday, seeing the AT&T signage everywhere, watching it get picked up on CBS, all the places where it's getting played.
Yeah.
And I just started thinking about the Super Bowl and how it's now $5 million for 30 seconds in the Super Bowl. I don't know how much this costs, but is this more or less than that? How do you kind of look at this and think, okay, this is what we're spending and this is why?
Well, we've never disclosed what we pay to sponsor this. I hope Jay Monahan is in bed because he's the guy that we negotiate these deals with. But I would tell you this is the best ROI of any advertising promotion that we do. And, you know, we're interacting with some of the biggest customers in the B2B world, And it's a great event. It gets great carriage for both the consumer as well as businesses. It just crosses the boundaries of multiple demographics. So we just love this event for that reason.
And just in terms of the pure golf fan, you know, there's only 4 majors, but I'd have trouble, you know, the next 4, this would probably be one of my, and plus there's a major being played here later this year. So the venue here is so amazing. And then you throw in Spyglass and Monterey. It's like, I think it's the best non-major event of the year, don't you think?
I really obviously agree with that. This is it's really a freakishly unique event because you're playing with the best athletes in the world, and amateurs are inside the ropes.
That's the part. You're looking at me. You're right. If we're out there in the same ropes as.
While they're playing with live ammo, you're in there inside the ropes playing the exact same game they're playing, and your shots matter. And it's really strange. Think of what other sport exists where amateurs get into the live play with the real athletes and get to see them up close and in person.
And everybody shows up for this too.
Yeah, it's a great event. It really is. Yeah.
Randall, I want to talk to you about the disappointment the street had with the earnings last week. Stock was down, and I think it was because of the surprise in the decline in subscribers, both at DirecTV and DirecTV Now. There are people questioning on the street whether you can actually turn the TV business around there. What do you say to them?
The results were really right in line with what we had told the street back in November. And we had said we expect to see continued declines in the traditional video business. And what we are doing is now investing in a new streaming service. It's over in Warner Media. And you know, now that you own a large-scale media company, the idea that you can now build an SVOD, a subscription video-on-demand service that is premium, that is unique, it's leveraged off the HBO content, the Warner Brothers content, that is now where the investment is going for streaming television. An SVOD service. The traditional linear, we expect to continue to decline. We expected that when we bought DirecTV. We generated a lot of synergies with that acquisition. It was a typical synergy deal. You buy a declining business, you extract a lot of cost synergies, and people forget. Within 18 months, we had generated about a $3.5 billion run rate synergy in this business. Still generating $4 billion of cash flow. That $4 billion is now being invested in the new platforms. So it's being invested in fiber deployment, and the fiber deployment is going great. In fact, our broadband business in the quarter was up 6-7%. We're investing in an advertising business. And by the way, since we bought DirecTV, we have stood this advertising business up. It's a very unique business. It's a $2 billion a year business now, and it grew 26% last quarter. So we're investing in that and investing in the SVOD. So what you're seeing is investment in the traditional linear goes down. You'll see subscribers continue to go down. As we stand up the SVOD service, you're going to see significant growth over here. That's where our excitement is, and this is where we're putting all of our focus and our investment.
Would everything else have been possible if you didn't do DirecTV? Do you think it gave you a footprint, didn't it, to do this?
It would have been really hard to execute this strategy had you not done DirecTV, because you needed some basis to get content delivered to mobile, the world of mobile. That's what we were always trying to accomplish, and we've been trying to do that for many, many years. We actually got that done. We got all the rights to begin distributing to mobile within months of closing DirecTV. And so now you do a media company, you own a media company, and you own some great IP, and you stand up a new SVOD service, video on demand service. Now you have just built-in distribution for this SVOD, not only through your traditional DirecTV subscribers, but through your mobile subscribers. And so the two work hand in hand. The next 2 or 3 years, bringing these two together,
That's
standing
key.
this up and distributing.
I mean, is there a shareholder class that just wants more near-term results? It wasn't identical to what Comcast experienced with Sky, but initially looks like a great asset that Comcast killed to get it, and yet the stock, some people decide, look, the debt's going up too much. It's going to be, the payoff is going to be down the road. But if you're building something for the future, I mean, do you see it the same way? Who are the shareholders that decide I'm not going to be here, so the stock goes down? But long term, you say 2 or 3 years.
They're very similar plays that we're running. We have put a significant amount of debt on to do the Time Warner deal.
That's what has people.
And that's what concerns people. And I recognize that. And I have said, number one focus for 2019 is to address the debt situation. So think about what's happened here. We put on $40 billion of debt to do Time Warner. That was done in June. By the time we got to end of year, we had paid down $9 billion of the $40 billion. By the time we get to end of year this year, we'll have paid down 75% of that debt. So the ability to service this debt is very, very achievable. We've told the street straight up, you should expect us, after some of the highest capital spending in the U.S., to generate $26 billion of free cash flow this year. We just did 7.9 in the last quarter, 7.9 billion in one quarter. 26 billion, we'll pay a $14 billion dividend. There's $12 billion of cash that will go to debt pay down. We have asset sales that are stacked up of 6 to 8 billion. There's about 30 some odd billion dollars. So you'll get to 75% of the debt paid off as we exit this year, an imminent line of sight to doing the rest in 2020.
You did mention, though, $14 billion a year in dividends. I think the yield's something like 6.9%. And that has some people starting to wonder. I think the majority of analysts still believe that the dividend is completely safe. Is there any chance that you would either reduce or freeze the dividend for any point of time to pay down that debt faster?
The reality is that we don't even have to talk about that. When you generate $26 billion of free cash flow and a $14 billion dividend, that's not even in the equation. You will have $12 billion after paying the dividend. And that is while you're investing at the highest levels of anybody in the United States of America. So the cash flow characteristics of this business are really unique. I mean, they really, really are. To think about, come out of the first full quarter where we own Time Warner, and we have record cash flow, record operating cash flow, record free cash flow. Free cash flow is up 70 some odd % for the quarter. And so the cash flow characteristics are performing exactly like what we anticipated. And so, as we exit 2019, I think people will be comfortable with our ability to manage the debt. People talk about $170 billion debt. Well, it's a $60 billion EBITDA company, okay? So the debt is eminently manageable, and so people get more secure with the dividend. I'm confident as we go through 2019.
Do you hear things about the time frame for finding out, the latest challenge from the government on the deal? It was supposed to be the end of this month, wasn't it?
Yeah, I think.
Do you know?
Our lawyer's expectation is it should be this month. We should hear something this month.
And any body language about, was there anything new? Because that judge was so definitive last time.
So there were oral arguments in front of the circuit court in December. Yeah. And we left those arguments feeling very good about how the discussion went. But, it's the courts, so you don't know until you get the ruling from the judges. But we're feeling comfortable right now.
Andrew has a question, as you can probably hear him saying.
Yep.
Yeah.
Hey, Randall.
Go ahead, Andrew.
Good to see you. I don't know if you saw this headline, but I did want to ask you about it because it's making news. Sprint filed a federal lawsuit yesterday against AT&T over your use of 5GE in your marketing. This is the sort of next generation 5G, I guess what you're calling the 5G evolution in place of LTE. They're saying that's effectively marketing fraud, that AT&T doesn't have a 5G service available to the public yet. How do you respond to that?
Well, it'll play itself out, obviously, but we feel very comfortable with how we've characterized the new service that we're launching. What we do, Andrew, we go into a market and we turn up a significant block of spectrum, wireless airwaves that we own. It's rather dramatic, and we're deploying new technology that I won't go into the details of it. But when we go into a market and we turn up this technology and we light up this spectrum, our customers are seeing radical increases in speed and performance on the network. And this is a step. This is a step that's required to get to ultimate 5G. and it's an evolutionary step to 5G. It's a critical step. And so we are characterizing this as 5GE, 5G evolution. And we've obviously done our homework. We've done a lot of work around how we characterize this, and we're being very clear with our customers that this is an evolutionary step. But this is a dramatic step change improvement in what the customers experience where we turn this up. And I fully understand why our competitors might be upset with this. It's not a play everybody can run. It's a play that we really like, and it's a play that's going to differentiate us in the marketplace as we begin to roll this out over the course of this year.
Are you going to the Oscars this year?
Probably won't see me at the Oscars this year.
Stanky going? I mean, who's the mogul?
Stanky better be there.
He's got to be there.
He's got to be there.
And you will see him there because he's
Absolutely.
like 8 feet tall. But is he,
So you will see him. Yeah.
He's your mogul representative.
He is
for
the mogul. I mean, he just screams.
I always saw
mogul,
you
doesn't he?
moving out there and just hobnobbing with all. No, I didn't see that actually. But anyway, thanks.
Thank you,
for
Randall.
Good seeing you guys. Thanks for being here.
Thank you, Randall Stephenson.